Hello and welcome to the New Zealand Retirement Podcast. I'm your co-host and registered financial advisor, Raiden Page, alongside my co-host and fellow financial advisor, John Milner, CFP. This is the podcast that brings you all you need to know about retiring in the New Zealand context. So without further delay, welcome to this week's episode.
So one of the subjects, property, and Kiwis have got a love affair with property, well, as does many places, Australia, certainly New Zealand. And I think when I'm talking to clients, we really have to get an idea of what their objective is. For some people, it's growth, of course, when they're younger, building an asset, maybe in either a home or investment. But then again, and for a lot of people, for a number of decades, it was very, very strong and very, very good for them. They did very, very well, no doubt about it. But for other people, maybe if the things are switched over and they're looking for an income, it's not so great, depending on which region you're talking about. But if you're looking at Auckland, you could be looking at a net, 2.5%, if you're lucky.
Yeah. I mean, some of the regions you might get up to 4 or 5% at the most, and you've still got all the rest that you've got with property. Have you had a lot of experience with the commercial side of property?
As in like these property syndicate funds, an awful lot of the cost is transferred to the tenant, and you can get reasonable returns from them. But they tend to be a chunky investment, and once your tenant's gone, they're gone, and you're going to hunt around for somebody else. For some people have done very, very well, but my exposure, I guess, has really been these property syndicate funds. They've bought many large commercial businesses or buildings, at least, and I just stay away from them. As attractive as they appear, and some of them have been very, very attractive, 7 to 10% returns. I saw one of them was 30% return over like a 10-year lock-in period with another potential 3 years on top of that. But liquidity is the issue.
I think that's probably what we're going to talk about today, is that you need that income, so you need some certainty that it's going to be there. And some of the risks that sit in behind property are some of the things you don't immediately think about. Your vacancy rate. What happens if your favorite tenant moves out and suddenly you're trying to find someone new? You might find someone that isn't such a great tenant. It takes you 6 months to kick them out. It might take 3, 4, 5, 6 months or even more to fill the vacancy. So then you're topping up the mortgage, because if you're investing in property, you're probably geared it to try to outperform shares. So that's one of the issues that we come across, right?
Mm-hmm. That's right. Yeah, absolutely. So yeah, that's right. Yeah, I don't think much of the risk is really talked about.
Yeah,
that's going to be factored into the return, right?
Yeah, exactly. And that's, I don't want to get too into the weeds with that, but that's why it doesn't exactly fit on our what we call the efficient frontier. When we're investing, the only reason why we chuck property in the portfolio is because we want some diversification out of it. But property moves quite similarly to shares, so that the amount of diversification you get out of it is pretty low. So in terms of the efficient frontier that I'm talking about, that's looking at the return that you get for per unit of risk. So you're taking on a risk, your return is going to be hopefully commensurate with that risk. And what we see with property is if you just did a combination of both shares and bonds, long term, you're better off just holding a share and bond portfolio rather than chucking property in there at all.
Well, that's what, probably 15 plus years ago, people I was working with made that decision where having that extra asset in your portfolio means another asset to rebalance, which comes along with costs, with rebalancing, and when it really doesn't perform to an extreme level against the other part of the portfolio, you've really got to ask yourself, what's the point? If you've got an overall, well-diversified portfolio, there's a very good chance there'll be property in that portfolio anyway, or property companies operating within the property sector. So we opted out of a separate property asset, a number of years ago now. Probably over 15 years ago for that very reason. Yeah. So it wasn't really, the negative, I should say, correlation wasn't big. There wasn't a lot of big difference between the shares and property. So it was out the door.
Absolutely, which would make sense, right? We want to get the best return per unit of risk. There's a reason why you don't go 100% growth in retirement. So that's potentially why we're not looking at property. Now, the other side of this is the property investors sort of approach, and probably the easiest thing to talk about here is the leverage that you get out of property. So as we probably all know, listening to this, over the past 20 years, property's gone absolutely gangbusters. We've seen a real return around 3 to 5% a year. I think it's closer to 3. So 5% before inflation. But what you've been able to do with that 5% is you've been able to gear up 80% of it, which means you can multiply your effective return by 5, so that you're only putting in 20%, and that 20% is increasing, 15.
It's like a magnifying glass, isn't it? I remember Mary Holm, the financial agony aunt from the Herald, basically saying that it's like a magnifying glass. You're magnifying the pluses, the upside, but you're also magnifying the downside.
Yep, yep. And that's what I remember. I worked in a mortgage brokerage for a time, coming straight out of uni, and what they would talk about is how property never goes down. And I'll never forget that property never goes down. And I couldn't really say anything against that. I mean, it sort of made sense, right? Like we'd been through 20-ish years of just straight up. The last time we saw a fall in real terms, that's after inflation terms, was I think the 1970s or 1980s, when we had that massive bout of inflation. Property didn't keep up with that inflation. But in recent memory, that recency bias coming in, we just saw property prices increase and increase and increase and increase. So what was really interesting there is they could say with a bit of confidence, they could say, what you do is you just invest in property, right? And you get your property, you put your 20% deposit down, and then you pay down the mortgage. And why you're doing that is you're trying to create that 20% up to be bigger so that you can use the amount that's over 20% to buy another property again.
Uh-huh.
And you just keep going. And as you go from 20% to 40%, you've got enough for an equal value property. You take that 20% in equity that you've got from property number one and just buy property number two. And then both of them are going to be growing ad infinitum. And eventually you can buy another and then another, and it just happens faster and faster and faster. And because property always goes up in value and is compounding with that leverage, it's a no-brainer. Nothing else can beat it, right? That's the logic. That works. That works perfectly. If you're happy to price people out of the housing market forever, that's the plan. And unfortunately for society, it's a self-fulfilling prophecy. Because if I tell you, hey, look, John, how about you buy this house off me for $1 million, and I promise next year it's going to be worth 1.1 million. Who in their right mind is going to say no to that?
Totally.
Your property is going to make more money than you are. So that's entirely rational to go, oh yeah, I'm just going to put everything in property. And from a social perspective, when we look at property, that we've had that pullback. So we've had some realism come into the market that actually you're not just taking on this free risk where property always goes up in value. What you're facing is a trade-off still. There is still risk inherent in property.
Raiden, I can smell the socialism on your breath coming through the stream.
Socialism, maybe not so much socialism, but I just remember back in what would have been I think high school, the 2000s and early 2010s, and I remember housing being such a cool thing to think about and look forward to, and it was this thing that could potentially be a future for myself and my peers. And as I grew up through the years, I realized that it just stopped being possible at a certain point.
Sure. Yeah. As it is with a lot of countries, unfortunately.
Exactly.
It's the norm in, a lot of countries. I've got a friend in New York, and he lives in an apartment. He always will live in an apartment, and the mere idea of owning your own home is foreign to him. That's for sure. I don't like that at all. I really don't. But yeah, this goes against the grain of the average Kiwi with property. I think I like the idea of having a home, a base that's paid for perhaps, but not so much maybe the investment on the property side of things, certainly going forward from here, at least anyway, for the short to medium term. It's just not as attractive. I've met a number of people over the last few years. I met somebody the other day whose family came to New Zealand in the 70s. They thought maybe the property might be not a bad idea. And that family over 2 generations acquired 20 properties. I think they're down to about, talking to the son now, I think they're down to about 4. And he's slowly liquidating those as well and investing with me, as he doesn't think it's the same anymore. I met another gentleman came in originally from the States and been living here for a very long time, and that gentleman has 40 properties. 40 properties. It's just, how much is enough? It just seems a little bit obscene to me. But the good news is with investors, I think the average investor is, I think, technically speaking, about 1.5% houses, if that's possible. So the average property investor doesn't own 20 or 40 properties. They just don't. You certainly do have people that do, but not many. In fact, I came across a gentleman who was a prison officer at Mount Eden Prison. I was doing mortgage business with the prison wardens there. And God, I used to hate going into that prison to see them But yeah, there was one guy there apparently had 26.
Yeah.
He was making way more than he was ever going to make in the prison, that's for sure. But over time, he'd
Absolutely.
acquired that. And I guess a lot of it came down to timing as well. The environment was right. Whether it will be in the future, who knows?
Yeah. So I think I've done my preaching for this episode, and I think what would be interesting to talk about now is to get into the why wouldn't you do it now from an individual perspective. So let's say you've got two properties now. You've got one rental, one that you live in. Say paid off on the one that you live in. You've got the 80% mortgage now. What risks do we face going forward with property? And is property still the right decision?
I guess one of the arguments coming from a property investor would be, well, yes, I've put down a deposit on that property, but as long as it's cash flow positive or near enough to it, I've literally got a tenant and a bank helping me buy that house or paying for that house. I'm using essentially somebody else's money, which I do pay a premium for, to use their money, and I've got a tenant sitting there who's literally paying my mortgage.
Yeah. So it depends in our case, right? Because if you buy something like a townhouse in the regions, you could probably get a rate big enough to have that tenant pay off a large chunk of the interest and maybe some of the principal as well. So what are we sitting at now? Mortgage rates 5-ish?
Yeah, maybe closer to 6, but yeah.
Yeah, 5 to 6. With rental yields being in Auckland at least 3 to 4, and then elsewhere rental yields are potentially 5, 6 if you're really pushing it with a nice townhouse.
Lower values,
low cost area. Yeah. So you can still do it, but it's now a subsidy more than the person actually paying off your mortgage, because that person's only paying
proportion perhaps
4%. Yeah, 4%. And you've still got to, in theory, if you're not doing interest only, you've still got to make up that extra 1% if they're paying 4%, and you get 4% is taxable. So the effective return on that isn't actually 4%, it's a little bit lower. So that's one of the risks going forward is we don't have that high of a rental yield. The person's not actually, your tenant isn't just paying off the mortgage, you're also contributing to it now as well. And what happens if this market decline goes on for a period of time, right? What if we see house prices stay reasonably stagnant over 5 years? Now you're sat there topping up the mortgage, and while that's not necessarily bad, you look at the opportunity cost of just saying goodbye to that property and investing in shares. You're giving up that ability to compound and the diversification that adding in shares and bonds adds. If you're just in property, you're just focused on the New Zealand property market. That is quite a concentrated position.
Yeah, well, I can imagine. Yeah, just imagine if you could, and you certainly can, obviously, in other countries, do the same thing with a decent share portfolio, a good diversified share portfolio, that is. We're able to maximise that with lending.
Yeah.
I suspect it would smash it.
Yeah, well, it should do on a risk-adjusted basis.
On a decent diversified portfolio, that is, taking away some of that risk, concentration risk, which again is what you have. I mean, I've had, I guess, distant family that bought some units a little bit further down the south on the North Island, and over the years, the area really had changed quite significantly, and it was no longer an attractive proposition for people to rent, and those units really just devalued a lot because of that. So sure, they may have had people going in there to pay some of that rent, but the overall capital value was eroding over the years. So there's a lot of risks. There's a lot of risk. You got your damage from tenants and all sorts of stuff. And I guess it's just depending on what people feel comfortable with. But possibly now, maybe things might have changed. Perhaps I don't know. We don't know the future. Who knows? Maybe in 2 or 3 years' time, things will change again. We'll have immigration romping through the country and people looking for homes to live in, and it might change all over again. I don't know. But I've never felt comfortable to do it.
Yeah. So for the investor that might come to you and say, "Hey, look, I'm in property. I understand property. I don't really understand this shares and bonds thing." How do you explain to them about how it would work, them potentially moving from property to a diversified share portfolio at age 64, 65? How would you explain how that works?
Yeah, I guess there's many advantages to it. Diversification is one. You buy one property, you sink or swim in that property. Whereas we're investing in, I guess, capitalism. We're investing in companies that are providing a service or they're making a product that you probably use every day of the week. They're completely liquid. They're tradable. They're literally being bought and sold every day, 5 days a week, on the markets around the world. I'm not talking about assets that are off market, private, although that seems to be rearing its head again at the moment. Diversification, liquidity. You're getting good, strong long-term returns, and you're investing in an asset that's literally producing something, whether it's a service or a product, which is good for everybody. You're able to value it on a daily basis. I mean, we don't have property valued on a daily basis. I mean, if you were to do that, you'd see those spikes, those troughs and highs and lows on property value, just like you would with shares. It's just that it's so much more transparent with shares.
Yeah, and if we talk about the mechanics of actually doing it, I should actually get my little book here that tells me all the probabilities of shares going up and down, but whatever it is.
Yes.
So a lot of the time shares are going up, right? The vast majority of years, shares are going up.
Mm-hmm.
It's something like 70%. And the way that it works is what we do is you want a retirement lump sum every year. We can use the bucket strategy where we take your annual income that you need and we can take that out of the portfolio at one point in time at the beginning of the year. And that goes into a bank account and you transfer yourself money every month. And then the next year we take another lump sum of money out of the portfolio. So because shares and bonds are growing most of the time, we have drawings from the portfolio. And as I said, that can happen once a year if you want to use some sort of bucket strategy, or it can happen once a month and you get just paycheck from your investments instead. And because they're growing, you're only taking a small chip at a time. So there's a couple of different strategies there. So instead of you bringing in rent as you're used to with rental property, you're bringing in the drawings from the portfolio, which are growing all the time in the background. So while the bit that you're not drawing on, which is probably the vast majority of the portfolio, that's growing, and you're just taking small chips out as you're
Sure. Yeah, it's either growing with capital increase, the valuation of the company, and or dividends and interest. Yeah, yeah, yeah. Dividends usually get that rolled through every quarter, and so more
yeah. So
transparent
it's
valuation on a daily basis, completely liquid, tradable. If you were to say put that magnifying glass on that, wow, that would be pretty spectacular. But or could be pretty spectacular. But we don't have that in New Zealand, and maybe a good thing because sometimes it's used the wrong way, like a lot of things, and people could be harmed by it. So I'm quite comfortable investing in the share market through low cost, broadly diversified portfolios.
yeah, that's exactly it. Yeah.
You're likely to get a long-term predictable return. We've got a good idea about how these things do perform over the long term. So we're able to give our clients, reasonable certainty of what that future is going to look for them.
Yeah. So yeah, mechanically, it's actually quite similar to the same way that you invest in property. Really, with property, you get your rental income. With investments, you just take basically capital gains off the top, maybe a little bit extra in the capital, and then the underlying capital that you're not taking out just continues to grow in the background.
Yeah, well, that's the big thing as well that we talk to clients about is having a property. You're going to get X return from the yield, the income from the property. But what if you need more? You can't go to your tenants and say, "Listen, this is a 3-bedroom home. We're going to sell the third bedroom because we want to go away to Fiji." You can't do that.
Yeah.
Certainly, with a diversified portfolio, you can start to consume the capital as well. I mean, why wouldn't you? If this is retirement money as an example, why wouldn't you consume the capital as well and get a real bumper income from it? Otherwise, what was the point?
Yeah.
Did you
And that's
did you slave away for 30, 40 years only to hand that capital over to somebody else?
Yeah, and that's what the planning's all about, right? Like
Mhm.
that's what we do. That's why we say if you want an amount of money, say at the end of retirement to give to the kids, or maybe you just want to know how much can I reasonably give now and still have with high probability that retirement money over the whole period. That's the bit that's important. We work out what you
It
need,
can be
what your
done. Yeah,
goals
that
are,
can be done.
and we
Absolutely.
put the job to it. Yeah.
Absolutely. It just comes down to, I mean, when you're talking to somebody that's come to you for retirement planning, it's all about them, really. Sure, we can allow for kids or somebody outside of that, but in reality, it's all about them and what we get out of it for them.
Yeah, yeah, and that I mean that this investment money, oftentimes what we want to do is our main goal would be to have it run out as soon as you run out of life. You run out of money as soon as you run out of life.
Sure.
So you've lived the life to the fullest all the way through through retirement. You've done all the things that you want to do, and we've constantly had that reflective and preemptive conversations about what's possible in the future, what do you want to do for the next year, and so on and so on.
Absolutely. Yeah, absolutely. Living their best life. And it's not sitting there waiting for the next tenant or just say, taking a little bit
Going
of
around to
little bit of a return off the top of the portfolio. It's really making the most of that portfolio to make the most of your life and to create memories. That's the whole idea. I mean, that's, as I said, that's the whole intent of life is to create memories. It's not to be the richest person in the cemetery.
love that. Yeah. So a couple of things I've come across is with business owners that say they come to sell their practice. Maybe they own some sort of manufacturing business, or they own, say, a dental practice, or own a GP practice. And one of the things they might say is, part of my planning, I want to keep the commercial property that sits that houses my practice, and I'll just sell the practice myself, so I can get that rental income still from that practice that I've sold.
Sure.
And that'll supplement my income. Do you have any thoughts about that approach?
Well, there's nothing wrong with that, I guess, but they have to appreciate that it does come with some risks, and you'd want to make sure that that return that they're getting from that means that some of that risk is built into the return, that they're getting rewarded for the risk they're taking. Maybe they are getting rewarded for that. Well, okay, if that's the case, well then it's fine. And if that income's adequate, if it's enough, well then taking the risks, taking the return into consideration. But again, at the end of the day, it's not a liquid asset. If they decide to have a major change in life, they want to go in a different direction, there's a whole lot of things that's got to go on before they can make that change.
Yeah, and you can't just sell the building at a certain point in time. You just go, oh yeah, next year I want to do this. It takes time to sell that
Next
building.
time, it may be the right time to sell in the market. It may not be the right time in the market. But again, each case is different. It could very well be that person is very comfortable where they are with that property. The return they may be rewarded for the risk they're taking. And if that all stacks up and you're able to identify that, well, I guess then it makes sense for them, if they're comfortable with that. But there's a lot of pluses and minuses to it. And I think as advisors, it's our job to actually draw that to their attention.
Yep, cool.
I think, is there necessarily any rights or wrongs? I think it's just a case of whether they're comfortable with what they've got, but they've got to know what they've got. I'm sure you've spoken to many people that, like I have, that simply don't know.
Absolutely.
They don't know, and so once they are aware of the situation, then they can make a decision.
Informed decision about the trade-offs.
Mm-hmm. Yeah, trade-offs, absolutely.
That's why we love our investment planning processes. We can jump on the crystal ball and say, here's how it's tracking.
Yeah, well, I guess too, a lot of people at times know the answers to the questions they're asking, but they just, we have to draw that out of them to help them get that into the open and discuss that. And so if they are invested in a property, we need to bring to their attention the pluses, the minuses, as we've just discussed, and then they can make that decision going forward. And quite often they'll, I guess deep in their heart, they know the answer, but sometimes it helps when somebody else is there with them.